In this video, we're going to explain whole life insurance in simple terms. My goal is to help you understand how cash value works so you can pass your exam with ease. Hi, I'm Chris Jaffe with Life Health Exam Coach, and we help aspiring life and health agents pass the insurance exam. If you'd like our free Life Health Exam Study Guide, please visit www.lifehealthexamcoach.com or click the link in the description below and we'll get you access. All right, let's dive right in. We're going to talk here about whole life basics, and you'll see in the chart here what I'm talking about as I go through each of these important points to help you. So first off, whole life insurance is permanent insurance. It's permanent coverage. It lasts your entire life. And that's as opposed to term life insurance, which you might have studied in another video, which only lasts for a certain term or a certain period of life. So whole life is just that. It lasts your entire life. You're covered in the event that you die. The death benefit example here is a $100,000 policy. So it's going to pay that full amount either at death or at age 100, which is also called policy maturity. That's an important term for you to know. Policy maturity is that point where it's going to pay that benefit out. If the person were still alive, then that money's going to go straight to them instead of their beneficiaries. If the insured lives past 100, the policy automatically cashes out. So at that maturity point, like I said, that's when it's going to go, directly to that person rather than the beneficiary. So most of the time that doesn't happen. Occasionally, some people do live to age 100, but those policy maturity dates might even be higher, sometimes as high as 110 or 120 years old. All right. Another important thing about whole life insurance is the premiums are definitely more expensive than term. Why is that? Well, term insurance is temporary. It has no cash value, so it's going to be less expensive. So for example, you might spend about $25 a month for $100,000 worth of coverage. Why? Because it's not going to be there for your whole life, and statistically, it probably won't be there when you actually die. So it's good coverage for certain situations, but it's definitely not going to be there for your whole life. So the whole life insurance is permanent, it builds cash value, and it's going to cost more because it is going to be there forever. So for example, that same example we're looking at here, $250 a month for that same $100,000 coverage. So that money is going to go towards building that cash value and also making sure that that death benefit is there at the point when the insured dies. Let's look at how premiums are split. So as I said, in whole life insurance, you've got two different aspects. You've got the death benefit and you've got cash value. So a certain amount of money from that premium that you're spending every month is going to be divided between those two, or put into, you should say, those two buckets. So $50, let's say, would be the cost of insurance. That's covering the risk of the person dying. The $200 is going into the cash value. So that's the savings component inside of this policy. Cash value typically earns a small interest, maybe around 2%. Depends on the policy. There are lots of different kinds of policies, which you'll learn about later. So let's talk about just cash value growth, though. With every payment, that cash value increases over time. So that's where it's similar to like a savings account, right? It's going to accumulate and it's going to keep building over time. The goal is by age 100, the entire $100,000 death benefit is fully funded by that cash value. So whole life is saving your own money for your own death, in essence. Let's talk about the insurance company's role in this situation. Early in the policy, most of the payout comes from the insurance company. So for example, at age 40, you might only have about $10,000 of cash value saved. The company is going to pay the other $90,000. So, that's where they're bearing the risk, especially in those early years. Later in the policy, most of the payout comes from your accumulated cash value. So, for example, at age 80, $60,000 is saved in the cash value account, company is going to pay the remaining $40,000 should the insured pass away. Again, by age 100 at policy maturity, the death benefit is 100% your money. And that's why if you don't pass away at that time, they give it back to you in essence. So here's a question some people have. Why not just use a bank account? Why would you put some of your savings into an insurance policy? A big reason is a tax advantage. The cash value growth is generally tax deferred. So that means it's not taxed while inside the policy. So for a person who starts at age 30 or 40, all those years they're putting the money in, that money is going to grow and accumulate tax deferred. So nothing paid out to Uncle Sam. And also, there is protection advantage. If you die early, the insurance company fills in the difference. So it's kind of like a savings plan with protection behind it. Without insurance, savings alone might not cover the full amount, especially if you die early. You might have a great savings plan, but the people in your family, your beneficiaries, aren't going to receive very much if you only have accumulated maybe $10,000 or so. Plus, they're going to pay taxes on it. So life insurance helps protect against taxes. It gives you a higher amount should you die before you've accumulated very much. So it makes a lot of sense for quite a few people. Sum up key features of the whole life policy. It has a guaranteed payout. The policy always pays as long as you're paying your premiums. That's for sure. Cash value access, you can borrow or withdraw from that cash value that's accumulated. But those loans reduce the death benefit if they're not repaid. So you have the option to borrow against the cash value that you have in the policy. You don't have to pay it back. If you don't pay it back, it's just going to reduce the death benefit at the point when you die. These policies all have what are called non-forfeiture options. That means if the policy is canceled, you're not going to forfeit some of the benefits that are in that policy. And there's a number of different choices available if you stop paying the premiums, and that's going to be covered in a separate lesson. Do look for that though, because it's important to know. All right, just to summarize what we've covered here today, whole life, it's permanent coverage plus a forced savings plan. The premiums are split between the insurance costs and the cash value savings. If you die early, the company covers that gap. If you live long, the benefit comes mostly from your own savings. This provides peace of mind that your family will receive the full death benefit no matter when you pass away. I hope this has been helpful to you. Again, check us out at lifehealthexamcoach.com and find other training videos that can help you pass your life and health exam. See you in the next video.